Hello students, welcome to Economics Simplified with Favor, where we break down complex economic topics into simple concepts that we can apply to everyday life. If you're new here, welcome to the channel, and if you're a returning student, it's good to have you back here. As usual, don't forget to hit that subscribe button, like this video, and share to other students who might find this useful. This series of videos is on Introduction to Microeconomics, as in MICRO, and we are using the textbook by Gregory Mankiw. Either the 9th or the 10th edition is fine. So today we're going to be covering chapter 19, which is on the market for factors of production. To start off, what is factors of production? This simply refers to inputs. So inputs means what are the things that you put into a business in order to be able to produce goods and services, right? So we're referring to things like raw materials, which are the inputs. And the inputs or the factors of production comes in different forms, including capital, land, labor, and entrepreneurship. So when you talk about capital, what does that mean? It refers to gadgets that we use, like the laptops, the desktops, or even like the oven, microwave, blender, all these things you use to be able to produce goods and services. So basically, machineries and equipment fall under capital. How about the reward for capital? So for every input of production, there is a reward, payments, or a return that you gain. And for capital, this is known as interest rates. So for instance, when you go to a bank to deposit money, you earn interest every month for your deposit investments. How about labor as an input? We, the people, the household, the families, usually supply our labor to the labor market. It means we render our labor services to the labor market for the firms or the businesses who demand for our labor. And as a result, we get wages and salaries. How about land? Land includes everything that you can build a structure on, right? So from your house to your business shops, all of that is built on land. What do we get in return? That is simply known as rents. And entrepreneurs. So entrepreneurs are those who coordinate businesses, the manager, the supervisors, who bring the whole business idea together, right? But is it for free? No. So as a return of their investment of their time and their resources, they get paid profits, right? At the end of, maybe every 2 weeks, at the end of every month, whatever the case is. So that is a summary of what factors of production entails. So what are the key assumptions for the factors of production? The first thing is that for the factors of production, for the inputs and raw materials to thrive, it has to be a competitive market where the demand and supply can compete and interact to form equilibrium market price and quantity. Remember that in a competitive market, there are price takers, right? The price isn't determined by one person, but it's rather determined by the interaction of the demand and supply. So take, for instance, in the labor market, we, the household, supply our labor and the businesses demand for our labor. So when you go for an interview, employers are going to ask you, how much do you want to get paid? And then you tell them your expected salary, and then they tell you, oh, okay, either yes, we can afford to pay it, or no, are you willing to come down to this level, right? So that whole negotiation back and forth between demand and supply is what determines the market price. So therefore, they are price takers. Another key assumption for the factors of production is that it's based on rationality. So remember, we've talked about rationality in previous chapters, but that basically means when the marginal benefit exceeds the marginal cost. And by marginal, I mean extra. So you only make a decision if the extra revenue, gains, income, payments, for whatever decision you're making exceeds the extra cost of production. And this is all based on the neoclassical theory of income distribution, which simply revolves around the fact that demand for inputs is as a result of the decision to produce goods and services, right? So because you have decided to produce and supply goods and services, then you can even demand for the inputs, the raw materials needed to make that production happen. So let's quickly take an example. We have labor here and we have quantity. So for different levels of workers, you have different outputs, which is your Q that is being produced. So how do we calculate marginal product of labor? Let's just refresh our minds. So remember, your marginal product of labor is your change in your total product as a result of change in labor, right? So change in total product means change in outputs or quantity as a result of your change in labor. And this is basically how much extra are you able to produce because you have an additional worker, right? So that's just what marginal product of labor, MPL, means. To calculate this, you just need to calculate the difference in the output as a result of having an extra worker. So when you go from 0 to 1 worker, your output increases from 0 to 30. So the difference is 30 minus 0, which is 30, right? And then when you increase from 1 to 2 workers, your output increases to 55. So 55 minus 30 will give you your difference, which is 25. And then you keep on going until the very end, at the last point where you have as much as 5 workers and then your output has increased to 100. So 100 minus the previous output you had at 4 workers is 10, right? Now, what is the value of marginal product? The value of marginal product is simply the gain or the benefits as a result of this extra output that results from the extra worker. It's calculated as price times your marginal product of labor. And this is calculated in dollars. So of course, by the time you introduce price, then it gives it the dollar value. let's calculate the VMPL. At 0 workers, you have 0 output, so there's nothing here. At 1 worker, assuming this is a popcorn market and the price of 1 bag of popcorn is $5. So $5 times 30 additional outputs that are produced as a result of having 1 worker, that's going to give us $150. At this point, it's going to give us 25 times $5, which is $125, right? So basically, that is the extra benefit of producing 25 extra bags of burger because you have 2 workers. And you keep on doing this up to the very end. 20 times $5 gives you 100, 15 times $5 gives you 75, and 10 times $5 gives you 50. The extra costs. And how do we compare the cost, right? So let's assume that the cost for this business is $90 per day for wages. Let's plot our total product curve. So on this x-axis, you're going to have your labor, which is your input. Remember your factor of production. So it ranges from 0 to 5 workers in this example. And then on this y-axis, you're going to have your quantity. And remember your quantity here ranges from 0 to 100, right? So let's assume you have these values on your y-axis. So to plot this total product graph, when you have 1 worker, how many outputs do you have? 30. So you trace it down from 30 to 1 worker. When you have 2 workers, how much output do you have? You have 55. So you trace it down to 55. When you have 3 workers, you have output as much as 75. So you trace that down as well. And then when you have 4 workers, you have as much as $90. So you trace it down all the way to 4 workers. And when you have 5 workers, your output is as high as 100. Okay, so you trace that down. And that is basically how you have your total product curve. So you see how it slopes upward? That shows increasing returns to scale. So as you add more worker, your total output increases. So that is increasing returns to scale up until you realize that the rate of increase gets slower over time, right? So the more workers you add, you see that output now increases by a lesser amount, right? It increases first by 30 units, which is good, and then it slowly reduces to increase by only 20 units. And by the time you have 5 workers, output increases only by 10 units, right? So therefore, use your IRS up till your diminishing returns setting. And in this case, since we're looking at total product and marginal product, then this diminishing returns to scale is also known as diminishing marginal products, which means that as L increases, your marginal products of labor begins to reduce. So basically, this is your output, which is the same thing as your labor supply curve, because it shows you how many workers are being supplied to this firm in order to give the corresponding outputs. So now let's plot the value for marginal product of labor. At 1 worker, you have your VMPL as high as $150. So you're all the way here. At 2 workers, your VMPL is as high as 125. So you trace it down, 125. And at 3 workers, you have your VMPL at 100. Here at 100. And at 4 workers, you have your VMPL at 75. And then at 5 workers, you have your VMPL at 50. So the value of your marginal product VMPL curve is going to look something like this. So my curve isn't perfect, but you get the gist. VMPL of labor. And this VMPL, the value of your marginal product, which is the benefits of having extra output that results from extra workers, is equivalent to your labor demand curve, while your total product curve is equivalent to your labor supply curve. So based on the benefits to the firm of having workers, extra workers, then they demand labor, right? So you see that the value of having extra workers reduces, right, as they have extra workers of labor. So therefore, what is the optimal number of workers to have? It is where your labor demand curve or your VMPL curve intersects with your labor supply curve, right? At the points between 3 and 4 workers. So this is where it intersects, right? And you trace it down. So we can't have 3.5 workers, so it's up to the firm to either just go with 3 workers or 4 workers, but this is just a hypothetical example. So now, remember that the points where you maximize profit is when your extra cost is equal to your extra benefits, right? And in this case, your extra cost is your wage, right? So that is why when you have the wage of $90 per day, then at the point where that wage equals the value of your MPL. So value of your MPL for $90, we don't really have VMPL at $90, so it has to be in between 3 and 4 workers, as we indicated before. So let's assume that the firm decides to go with the optimal point of 3 workers to maximize their profit. How about if your wage per day is more than $90? So let's say it's about $125 per day. Then you would see that at $125 of wages, the optimal workers you would have is better off at 2 workers, right? So basically, you see that just as the marginal product of labor reduces over time, as in diminishing marginal product, in the same way, the value of your marginal product of labor, your VMPL, reduces over time, which means reduced benefits. So from this profit maximizing condition, you can also derive your marginal cost, and I'm going to show you how. So basically, your wage is equal to VMPL, which is the same thing as wage is equal to price times your marginal product of labor. And if you want to make price the subject of the formula, then that is equivalent to saying price is equal to wage divided by MPL. Remember that your wage is your cost, and assuming that the only cost in this company is your wage, right? So that would be like your total cost divided by the change in your labor, which is your MPL. So that is equivalent to your marginal costs. And this whole equation is what determines your output supply. Meanwhile, this identity here, wage equal to VMPL, this is equivalent to your input demand. So remember how we started in this chapter? Your input demand is derived as a result of your decision to produce a certain output. So this input demand is equivalent to your output supply. Whereby your marginal cost is your change in total cost as a result of your change in quantity. Your input demand is also known as your labor demand curve. That is based off on your VMPL being equal to your wage, right? That forms how much optimal labor demand. And your output supply is based off on production, which is equivalent to your total product curve or quantity. And something that I want to emphasize is that if your price increases from $5, that is definitely going to increase the value of your MPL, right? But that causes a movement along your labor demand curve. There are other things that could increase the value of your marginal product of labor. So that includes things like technology, right? So if you have technology, it makes production more effective. If you have other inputs supplied in abundance, then that would also increase your VMPL. But that is going to lead to a shift in your labor demand curve, either to the left or to the right. Remember, non-price determinants causes a shift, right? And price determinants cause a movement along your demand curve. So quickly moving on to labor supply. What determines how much hours we are willing to supply in the labor market? Basically, it's a trade-off between work and leisure. If you work more hours, then that means you have less time for leisure. So if you increase your working hours from 8 hours a day to 12 hours a day, so now you're left with less leisure time. So wage is what you are giving up to get additional leisure. And remember, whatever you give up is your opportunity cost. So let's say you were getting paid $10 and then your wage now increases to $12. Right? Then that would be an incentive to reduce your leisure time and work more hours. Therefore, higher wage leads to higher opportunity costs of leisure, which means that you reduce your leisure and you increase your work time due to higher wage. Therefore, your change in your wage leads to your movements along the supply curve. So remember, just as change in price leads to movement along your labor demand curve and how much the firms are willing to demand labor, the same way the change in your wage leads to movement along your labor supply curve, your LS curve. But just as we have non-price determinants, in this case non-wage determinants that cause a shift in your labor supply curve, and this includes things like immigration preferences. So for instance, when you have more immigrants, then you have more people willing to work, right? So that is increase in labor supply, and that causes a shift in your labor supply curve to the right. Also, change in gender movements. So you know how we have gender equality over time. That has led to an increase in labor supply where you have both genders that are more readily available on the job market. As usual, we love our graphs in economics. So remember, labor supply is looking at the relationship between wage and work hours, okay? So you have your labor here and you have your wage on the y-axis. Let's assume at a wage of $10, you have someone that is willing to work for 8 hours, right? Now there's an increase in the wage to $12 per hour. That is going to be an incentive for the person to increase their work hours from 8 hours to, let's say, 12 hours. So now instead of making $80, the person is making $144 on a daily basis, which is pretty good, right? So therefore, your labor supply curve is an upward sloping curve. You see that? So increase in wage leads to an increase in work hours, and what that means is that you're sacrificing your leisure, so less leisure time. So something that is important to note is that your wage adjusts to the interaction of your labor demand and your labor supply curve. So now let's take a few examples. Let's draw our initial starting points of your labor supply curve sloping upwards, and then you have your labor demand curve sloping downwards, right? So at the first initial point, let's just say that the intersection of your labor supply and demand is going to give you your equilibrium wage. So let's call this wage 1 and then L1, right? So in this first example, increased retirement of older people means that there are less workers available in the car industry. And what that does is that it shifts your labor supply curve to the left, right? So remember, a reduction means that your labor supply curve is going to shift to the left. So you're going to have a new labor supply curve here. Let's call it LS2. So you see that at this new point, there is an increase in the wage, and that is because since we have less workers available to work in the car industry, that puts a lot of pressure on them. So there's going to be higher demand for the fewer workers available. And remember that scarcity leads to increase in price. In this case, the price here is the wage, which is the cost of the labor, right? Therefore, your wage is going to go up, increase, and your labor supply is going to reduce. And what this leads to is reduced workers, and that in turn leads to increased wage. How about the second scenario? The preferences of car buyers shift from locally produced goods, as in domestic goods and services, to foreign imported cars, right? So in this case, we're looking at cars. So you have your labor and you have your wage. Don't forget, you always have to show your starting point, which is your equilibrium. So your labor demand and your labor supply. When you say the buyer's preferences shifts, does this affect labor demand or labor supply? You're right, it's buyers, so it's going to affect your labor demand. And that is because if your buyers now prefer to import cars rather than domestic goods, then there's going to be less work for the producers to do domestically. Remember, if there's less production domestically, then that means they are going to demand for less workers. So that is why the shift in these preferences is going to reduce your labor demand curve. So remember, your demand in the labor market is different from your regular goods and services market. So demand in the labor market refers to the firms needing more workers as a result of needing to produce more, right? But in this case now, if there's less demand for workers, then what's going to be affected? Your labor demand curve. And that means your labor demand curve is going to shift to the left. The labor demand curve shifts to the left. So you have LD1, LD2. You have this new point of intersection with the labor supply curve. And at this point, you see that your workers actually reduce, but at the same time, your wage reduces. And that is because the car industry is not making as much output and profits as before, right? Since now, most of their buyers are going to foreign imported cars. So because of less production, less output, less profit, therefore, the reduction in the workers leads to less wages. So they're going to have to reduce the workers and reduce the wages that they're paying in order to still stay afloat in the business. How about the third scenario? If technology increases for domestic car production. So if there's an increase in technology, then that means the car industry is able to produce more cars, right? Then that means they need more workers. So that is going to lead to an increase in labor demand. So let's plot it here. Assuming we have our labor, as usual, on the x-axis and your wage on the y-axis. You have your initial equilibrium points between your LD, intersection between your LD and your LS curve. So therefore, starting point is here, wage 1, L1. Okay, now your labor demand increases, and when your labor demand increases, remember that it shifts to the right. So you're going to have a new labor demand curve, LD2, and when your labor demand curve shifts to the right, you see this new intersection point with your LS curve leads to increase in workers. Increased production means that you need more workers, and because you have increase in workers, you're making increased output due to the increased technology, then therefore your wage is going to increase. So therefore, in this case, increased labor demand leads to increased workers, and this in turn leads to increased wages. So do not forget that your wage is the rental price of labor, which is different from the cost price, as in raw material cost price. So in the previous slide, just the way we adjust labor up to the point where your wage is equal to your value of marginal products, that's the same way if you're looking at land, you would adjust the quantity of land up to the point where your rent, which is the rental price of land, is equal to the value of the marginal product for the land. And that's the same way it applies for capital as well. To find the optimal capital to produce, you adjust your capital up to the point where your interest rate equals your value of your marginal product of capital. So in that case, it will be VMPC, right, for capital. So basically, you would only buy capital, land, or labor when the value or the benefit, which is your rental payments, it could be rental income, is at least equal to the costs of production. But it's not every time that technology leads to increased production, output, workers, and wages. Sometimes it could be the opposite. So, for instance, when you talk about AI, for those developing the AI, that technology is going to lead to an increase in the wages and in the demand for AI workers, right? That's going to be this third example. But how about for other industries that they are able to use AI to substitute human labor? So for instance, even in the restaurants or even in the library, where you now have less human interaction because you have more technology inclined services, then in that case, that increase in technology could actually lead to a reduction in your labor demand and therefore lead to a reduction in the workers, demand for workers, which could ultimately lead to reduction in wages, right? So as an example too. So it could go either ways, but the first thing to do is to always ask yourself, this change in the trend, does it affect your labor supply or your labor demand curve? And then from there you go into plotting it, right? So if you say it affects your labor supply curve and it causes a shift and increase in your labor supply, then you can plot an increase in your labor supply. So you plot a new labor supply curve to the right. But if the change in the societal trend affects your labor demand curve, then does it lead to a reduction or an increase in your labor demand curve? And from there, you know whether to plot a new labor demand curve to the left or to the right, right? And you see where that intersects with your new labor supply curve, and then you trace it down to your new equilibrium price and quantity. So that is that for chapter 19. Thank you for tuning into this video. I hope you found it useful. Don't forget to like, share, and subscribe, and see you in the next video.